But having said that, there are always those silver linings to the clouds, and you've got some good earnings coming in, especially from Federal Bank. So let's welcome on board Shyam Srinivasan, the MD and CEO at Federal Bank, joining in right now. Shyam, hi, good morning. Thanks so much for joining in and talking about your numbers. Just tell us a little bit about, how strong the quarter has been for you. Profits, it's been a healthy loan growth, improved asset quality, stable margins. What would you say contributed to it all?
Thank you. And yes, like you pointed out, on many counts, this is our best quarter ever. On net profit, we had record growth for the quarter, and of course, full year was also an all-time record for us. Likewise on operating profit, likewise on credit growth, but notably the marked improvement on both gross and net NPA while we increased our coverage ratio was something that we were very happy with. We had good recovery, so I'd say it's fairly broad-based. And on growth, all our businesses have come together quite nicely. We've, over the last 3-4 years, had very good growth on corporate. We've been sort of ramping up our various retail verticals that have done very well. So I think it's fairly broad-based. Our target of being 50 wholesale, 50 retail is now nearing. We are at 53-47. So I'm of the view that the fundamentals are in shape. Structurally, we are better positioned. All the efforts over the years are coming to bear. So I'm hopeful that FY20 reflects this momentum and is even stronger. And our commitments that we had made at the top of the year to the market, our analyst community, our investors notably, have mostly been met. We talked about exiting at a 1% ROA, and without any one-offs, these have really happened. So I'm hopeful that we will repeat this going into FY20.
Yeah. Your ROA, that's your return on assets, has also improved to a higher than 1% for the fourth quarter, probably for the first time in many quarters. Do you sense that there could be further improvement coming in, say, over the next 1 to 2 years?
Yeah, Asha, if you sort of wind back, we were at 1.3 almost, and then for a range of reasons came down to 0.76. So I had mentioned that each year you will see 10 to 12 basis point improvement. So we moved from 0.76 to 0.88 to 1.02, and we are committing to a similar run rate over the next 2 years. So you're talking of 10-12 basis point improvement in FY20 and a similar improvement in FY21. So we are looking at exit quarter FY21 last quarter closer to 1.2, 1.25. Yes.
All right, but moving away from that then, Mr. Srinivas, let's talk about your asset quality as well. We have seen an improvement this time around. What led to this in the current environment, and where can we see your overall credit costs for FY20? Do you think that they would be lower than FY19?
Yeah, in beginning of FY19, we had talked about 65 to 70 basis points as the likely credit cost. As you're aware, in the middle of FY19, there was this catastrophic floods in Kerala, which did have an impact, and so we did signal that it may cause some stress, and yet kept the overall commitment of 70 basis points. I'm happy that we came in at about 0.67 or 0.68, but the exit quarter was remarkable at 0.51. It was also helped by zero slippages in corporate. That reflects the efforts we've put in over the last 3-4 years on the corporate book. We've stayed away from many of the now sort of more advertised credit stress segments. We didn't do long-term, we didn't do greenfield, we didn't do project financing, and yet grew at a healthy clip. So I'm hopeful that that's all sort of coming to bear. And retail and SME have traditionally been largely secured books, so there's not much of an issue, except for that it was affected by flood or some intervention of political reasons where there were some waivers. So structurally we are positioned we're talking about 55-60 basis points as a credit cost for FY20. So the underlying fundamentals are in place. The stress asset book of the bank is an all-time low of 1.72%, which is your net NPA plus your restructured plus whatever is sold to ARCs. That book has come down from close to 5% to 1.72. So all that indicates that the stress laid on the credit portfolio is playing through quite well, and we are conservative. We don't do too much of unsecured on a structural basis. We are very watchful. So I believe that 55-60 basis points is what we will deliver in FY20.
Okay, fair enough. What about, the SME slippages? We have seen the retail and SME slippages come down. Is this trend sustainable?
Yes, it is. If you see our numbers, the retail is, I think, a 10-quarter low, and likewise the SME has two components, the SME below 5 crores and the 5 to 25 crores. They too have come down materially. What has gone up is agriculture, which has hit an rather unfortunate all-time high. Mercifully, the number is controllable, but it's driven by local events in certain geographies, some waivers, some more sort of generous benefits to ensure that segments stay afloat. So we've made the prudent decision of taking the hit and moving on. So I would like to believe that those segments are faring well.
Your net interest margins have been pretty stable in the fourth quarter, Shyam. Can we expect further improvement in the margins to say near about 3.5% from the current roughly about 3.25% in the next 4 quarters perhaps?
Aisha, 350 would be like a really remarkable number for the reason that it automatically suggests that you're taking a different kind of risk on the book. So I am happy to be a little more conservative on that count and believe that the quality of risk-adjusted margin should be effective. If you see our numbers, risk-adjusted margin is 276. So if I do a 320 book with a 50 basis point credit cost and land at 275, or I do a 350 NIM and 75 basis point credit cost is the same outcome. So we're quite pleased to do 275, 280 kind of risk-adjusted margin, which effectively means 320, 325 NIM, which is our near-term guidance. If many things fall into place, cost of deposits fall, yeah, why not? But I would believe that at this point, our line of sight is more like 320, 325.
What would you say are the challenges that are going to hold you back? I mean, what is the worst case scenario that we could look at a scenario, I hope it doesn't happen, that your NIMs don't see an improvement?
I would not overly worry about NIM not expanding, because at 320 also a model suggests that we are well placed. I think what is important is the marked improvements that we've seen on the credit side should continue. There should not be any sort of outside event which suddenly sort of stalls the whole recovery proceedings that are going on. Mercifully, I don't have too much of the IBC related cases, so we are hinging all our recovery successes on bilateral transactions with customers who are singly ours or doing multiple banking. And just if the economy doesn't stutter and is just on course right now, we're gaining share, and I should believe that that gaining share will continue. Like I mentioned, we have a better organization structure, verticals focused on lines of business, business managers who are singly responsible for delivering P&L, and the network of the branches coming to work. So I believe that if there are no crazily outside events, we are positioned for this kind of run rate into FY20 and beyond.
Finally, Mr. Srinivasan, the bank has been very focused on organic growth, but you spoke about the overall environment right now. A lot of NBFCs are also looking at this point of time to merge with banks. How open is Federal Bank towards an M&A, and what kind of opportunities would you be interested in? I'm sure the street would like to know.
No, our theory is never catch a falling knife. So I believe that at this very juncture, of course the board has given a sort of hard look at what may be opportunities. As we speak, nothing that we are greatly excited by. Either what we want is expensive, or what is available is not something that makes us get greatly excited. So I would believe that there may not be any big sort of adventure on that count. We will stay organic, but that said, if something good comes up and is affordable, yes. We did look at a few microfinance opportunities in select geographies where they give us distribution. We have no problems in looking at that again, as long as the price is right.
All right, we'll let you go on that note. Thanks very much for giving us a flavor of how the earnings have been, as well as what those possible opportunities could be. As Mr. Srinivas said, that they would look at an opportunity if the time was right and if it was lucrative enough.